Mangalam Sonia, many thanks for joining us. Now, the Reserve Bank has not given any exceptions to HDFC to comply with the mandatory liquidity requirement. However, the central bank has allowed the entity to raise its stake in the insurance subsidies to above 50%. Ritu joins us now with more. Ritu, what does this mean for HDFC?
Well, Shireen, there is relief on some fronts, but no exemptions granted on other fronts. It's really a mixed bag what's coming from RBI in terms of the relief that was sought for the merger of the $40 billion merger between HDFC and HDFC Bank. Firstly, on the priority sector lending requirement. Now, there, some leeway has been granted where RBI has said for the first year, you only consider 1/3 of your portfolio as on the effective date of merger for calculating the PSL, and then the remaining 2/3 of the portfolio of HDFC Limited can be considered over the next 2 years, so you can spread the requirement over the next 2 years. That is the first one. The other very important one where HDFC had sought an exemption was in meeting the liquidity reserve requirements. Now, there are two of these. First is the SLR, which is the percentage of deposits that banks invest in government bonds. Now, that is slightly lower when compared to banks, so HDFC Limited would have held a lower percentage of SLR compared to the bank. There's no exemption that has been granted on that front. As far as the cash reserve ratio is concerned, which banks do maintain, but housing finance companies don't really do it as per regulatory norms. Again, here no exemption has been granted. So on the effective date of merger, both the SLR and CRR requirements will have to be met by HDFC as a combined entity, keeping into account the large portfolio of HDFC Limited as well. The important relief that has come in is HDFC Limited's investments in its insurance subsidiaries, where RBI has permitted HDFC or HDFC Bank, because ultimately these subsidiaries are going to be housed under the merged entity. So RBI has permitted them to hold their stake in excess of 50%. But there are two other subsidiaries. For instance, HDFC Limited holds stake in HDFC Credila and HDFC Education and Development Services, which operates in education, schools, etc. There it is said the shareholding will have to be brought down to 10% in the next 2 years. So again, some leeway granted for them to meet these requirements. There are certain other exemptions which have been granted when it comes to loan against shares, the interest rate benchmarking, because of the differential interest rates between the bank and HDFC Limited. And then lastly, in terms of income recognition, that is, how do you, what kind of provision do you set against bad loans, etc. That will have to be aligned. But again, let me reiterate, the merger was announced 1 year back. So there's been ample time for HDFC, while it was waiting for these reliefs from RBI to sort of balance its books. So it shouldn't come as a huge negative. We're also being given to understand from our sources within the banks that they're well placed as far as meeting these liquidity requirements also is concerned. So we'll hear more from them later in the con call, but doesn't seem to be a big shocker at all.
All right, Ritu, many thanks for joining us.